This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. The particulars contained herewithin were obtained from sources we believe to be reliable but are not guaranteed by us and may be incomplete. The opinions expressed are based upon our analysis and interpretation of these particulars and are not to be construed as solicitation or offer to buy or sell the securities mentioned herein. The opinions expressed do not necessarily reflect those of National Bank Financial.
Hello and welcome, everybody. Thank you so much for taking the time to view our quarterly podcast. Hope everybody had a wonderful holiday season. Get some time off.
Happy New Year.
Happy New Year. Happy New Year.
We're back.
Almost tired of saying it, to be honest with you. It is the 11th, but
we're back.
We're back. We're ready
back
as
for
ever.
more.
Obviously, interesting year last year. We're going to get into that.
Crazy.
Another interesting year probably upon us.
That's for sure.
As always, today we're going to go through the classic quarterly update, as we always do. Ken's going to touch on a little bit of the markets, a little bit of the economics, and then pass it over to me, and we're really going to dive into what is going to be the strategy heading into 2024. How do we prepare ourselves for this, I'm going to say, probably volatile year yet again?
And
What kind of changes are we going to be making in the portfolio as a whole? But without further ado, Ken, pass it over to you to go through your market and economic update.
Yeah, thanks. Well, thank you very much for taking the time to view this webcast. Last year was an incredibly interesting year, and so many different dynamics, so many different moving parts, and it's always great when we enter a new year because I always like to go back and look exactly what I wrote as the macro call last year. And after 40 years, you know that I've always said forecasting is not an exact science. But when I go back and I look at what we said a year ago, we got a lot of things right. We took the contrarian view. And if you go back, we had a decent 2022 because in 2022, we decided we'd take some risk off the table. And then in 2023, we put some of that risk back on the table. So one of the first things that I said to you last year, which I'm going to say again this year, is volatility is absolutely here to stay. So if you look at the chart of the S&P 500,
wild ride, huh?
That is a wild ride. Yeah. So even though I didn't put the numbers here, in the month of January, the S&P was up 6.2%. Fast track, we're out of the gate, looks fantastic, only for the bears to join in and celebrate that in February, the S&P went down about 2.5%. So then it was all about the Feds. It was all about, okay, how high are interest rates going to go? When are they going to stop? Where's inflation going to be? The market got excited all the way through to the end of the summer and went on an 18, almost a 19% ride. Then, of course, the volatility kicks in, and we had a dreadful September and a dreadful October.
Yeah, there's the higher for longer stance from the central bank.
And the bears were celebrating, saying, okay, we told you so, we told you so. And we don't like to use the words, this time is different. Okay, always scary words to use, but Definitely. We stayed to our conviction after the S&P dropped for those 2 months, 11.5%. Then we said, hang tight. I wrote a piece in November and I say, hey, look, things are still looking okay. Inflation looks like it's coming down. The Feds look like they've stopped the tightening. Corporate profitability still remains strong. And what do we get? Bingo bongo. Up 15.7% for a total rate of return of over 24%, which left most market strategists and market pundits shaking because they've got it terribly wrong over the last 2 years.
2 years
collectively. Yeah. So if you go to the next chart, just to illustrate some of the points, and we don't have to go over all of them, but central bankers, obviously, with how fast the tightening cycle was, much faster than most tightening cycles we've seen in history before, and that was the key play on the magnitude of how fast that rates went up, and nobody really had a rear view mirror to kind of get any type of projection on what that was going to look like. So I think it was difficult if you just focused on that one thing. You had to look at a bunch of different things. We looked at the fact that we still thought stock valuations were cheap.
Right in January, we kept saying that, you know what, the S&P 500, the Nasdaq, a lot of these, I would say, growth-orientated tech companies were at substantially not cheap valuations, but they were reasonable, right? And we touted that, especially at our November luncheon that we did in 2022, right?
Yeah, exactly. And exactly what I also said at the Tom Dean's luncheon was, hey, there's opportunity knocking here.
Mm-hmm.
And we were against the consensus view because the consensus view is that earnings were going to drop anywhere from 10 to 12%. And here we have Dan Devikowicz, who manages our various U.S. focused growth. And at the beginning of last year, he was saying he was going to get 18 to 20% growth off his portfolio. And quite frankly, I thought, okay, didn't you think that was somewhat unrealistic?
It was a little aggressive for what the street was pricing in, but needless to say, when
it happened,
it sure as did, and more. And we'll get to the returns later, but U.S. focused growth up over 40% for the year.
Yeah, and so again, going against the grain, got that incredibly right. And I think the big surprise of 2023, and I'm sure you would agree, Code, that how resilient the consumer was.
Yeah, 100%.
Now, I know their savings went down, but the reality is with rates going up, they still maintained a high level of spending, which is over 70% of GDP. And that's why corporate profitability, certainly...
it didn't slide nearly as much as what was anticipated.
Yeah. So, that was a big thing. And, if you could look back in the rear view mirror, and if you can really remember the deep, dark days of October of 2021, when the market hit the bottom, okay? That was the perfect bottom, October of 2021. And in October of 2021, there was a mass exit from mutual funds and ETFs, and investors were net sellers at the very bottom.
Yeah.
For me, that was a great contrarian sign because, as it turned out, was there a better buying opportunity?
No. That was the bottom.
That was the perfect bottom, and that's why we always say it's not about timing the market, it's time in the market. So I think that as we roll into the new year, I give it to you straight. My conviction for the market isn't quite as strong as it was last year because, when the Nasdaq moves over 40%, the S&P moves over 24%. The one thing that, if you go to the next slide, is that, hang on with that one, is that I think the market's going to, in a lot of areas, have a tough time repeating itself. But it was certainly a mixed bag. There's no question. Yeah. I mean, if you look at the magnificent seven of all the tech stocks, the Apple, the Amazons, the Googles, the Teslas of the world, I mean, Nasdaq was up an astounding 43%. Yeah. And is it going up another 43%? I don't think
Highly
so.
unlikely.
Highly unlikely. But the reality is that the market leadership last year was very narrow. Could that expand? Absolutely, it could expand going into 2024. But you take a look at both the Dow, S&P 500, Nasdaq, even the Russell, all did fairly well. You take a look at EFA, okay, which is Europe, Asia, and the Far East, again, did well. Well, what was the challenging area of the market?
Canadian equity.
And did we not call that?
Yeah. We said persistently that there would be pressure in Canada.
Right. And so when you look at that year-to-date figure of slightly over 8, if you take out Shopify, which is really Canada's only technology company, then you really have a rate of return for the Toronto Stock Exchange of a little over 5.5%. Yeah. So the real challenging area of the market was the Canadian marketplace. And the reality is that when you remove Shopify, if the Toronto market only does 5.5% to almost 25% for the S&P, that's a huge outperformance. As interest rates go up, it puts pressure on dividend companies, and Canada is notorious for dividend companies in terms of utility, energy, and banks. So if we look at last year at the banks just did dreadful. Like Bank of Nova Scotia last year, I think was off 8.5%. Yep. TD was off 7.5%. You had BMO was up, or I should say down about 2.5%. I think the only bank really, CIBC was up slightly, and Royal Bank was flat. Yeah. So that could be an opportunity going into 2024. Mm-hmm. We'll discuss that. We'll talk about that. But if you flip to the next slide, just to go over a couple of these things, what excites me and what doesn't excite me. I mean, the central bankers, everybody is betting. And the challenge is how much of the information that is prevalent today is already baked in the cake. Today, earlier, the inflation number came out in the U.S. It came out at 3.4%. It was flagged to be at 3.2%. This is on an annual basis. Yep. So, are they going to get their target to 2%? Absolutely, they'll probably get to their target. But the thing that concerns the both of us, and I know because we've talked about this, is investors could be a little overconfident here. Yeah. They think the first rate cuts are coming in March, mm-hmm. and they think the Feds are going to cut 6 times. I'm not so sure. If that doesn't happen, then volatility is going to increase for sure. Yeah. The thing that excites me too is like the AI. Please go on Chat GPT. If a 65-year-old guy like me can do it, I'm just amazed at what happens with this AI. And it's going to change our lives. It already is. And maybe it's going to change it for the good. And there's some bad things out there about it as well, like there are with most technologies. But I think that's going to be a really exciting impact, and that's going to lead the growth sector as well. But again, what is really exciting is today there is still record levels of cash mm-hmm. sitting on the sidelines of $5.9 trillion.
It's a hard number to fathom, to be honest with you.
So do you remember when, the calls that we took from some of the clients, and then, by the way, we're not beating you up here or whatever, but we did receive several calls. Well, here, you've heard this question a few times. Yeah. Why wouldn't I just put my money in a GIC and get 5% and not worry about this? Reason 4, that GIC is fully taxable. Mm-hmm. You have big investment risk, and you saw the S&P 500 do 24%.
And bonds just did 6.2.
And bonds just did 6.2. So rates are coming down. We know that. How fast? I'm not so sure. But all those GICs in 6 to 12 months aren't going to look nearly as good as they did a year ago. And I would anticipate as rates start to come down, you're going to see some of this market money into the market. So I'm not sure where we're going this year. I'm cautiously optimistic. We'll see how it plays out. But I think I'm going to turn it over to Cody because I think we've thought about this long and hard, how to position for for 2024, the inevitable volatility, where can we take profits, where can we trim, mm-hmm. where we can add. And I think this is a well thought out plan for 2024. So I'll turn it over to you, Cody.
Great. Awesome. So first things first, quick update on the mandate returns. I know we went through the market, and I am going to touch on it a little bit more throughout the presentation here. But quick update, it is going to be on the performance reports that we are going to be sending out next week.
And I will be calling you.
Ken will be calling. But here's all the data. All the fact sheets, all the website returns are going to be uploaded. But kind of moral of the story here is what was weak in 2022 and took it on the chin. Complete reversal. 2022, Canadian equity holds up, fixed income holds up, growth equities get absolutely hammered. Complete reversal. We have U.S. focused growth leading the way at 40.3%. We have international growth up 30%, small cap up 20%. All those names that got hit in 2022, complete reversal. So if you didn't really stick to your guns and you sold out of the growth story, you missed out on one of the best rallies on the Nasdaq since 1999.
Absolutely. The Nasdaq 100 was the best rally since 1999. Mm-hmm. And the other thing that I think is phenomenal is IFA did roughly 15%, mm-hmm. and our managers did 30. They outperformed their benchmark.
Or by 15%.
By 2 to 1.
It's
doesn't get any
large outperformance there. U.S. focused growth relatively in line with the Russell 1000 growth, mainly because of the fact that it doesn't hold NVIDIA in its portfolio, and that now has taken over a large portion of the S&P 500, rallying to all-time highs. But still, 40% within the year, relatively good. Our fixed income mandate in line with the benchmark, but
good year.
Moral of the story is there. 2023, the index within itself was down a whopping 11%, while we were only down 6%.
Yeah.
So to save on the downside, to manage your duration, manage your credit risk properly, only allows us to recoup faster. And our objective with the fixed income portfolio was not to take immense risks and bets at this juncture. It was mainly to stay in line with the premise that yields are going to come off at some point, and we want to maintain high credit quality, but lock in those bonds with the yields that are so attractive at this juncture, right? So relatively in line with fixed income. The only weak spot that we had in our portfolio, really, to say the least, was the Canadian side. And so you take a look, Ken already explained it, the Toronto Stock Exchange up 8.2% for the year, 2.42% of that being derived single-handedly from Shopify. And so the banks did horrendous, and we'll go through that in a sec. But it was just being the dividend mandate it is, being the Rock of Gibraltar in 2022. Unfortunately, it just wasn't the place in 2023. But that's the aspect of having a diversified portfolio. You have high income to hold you up through those periods of distress. Then you have the U.S. focused growth and international to give you that lift up during periods like we had last year.
Yeah.
And so all of that, it was pretty exceptional year. Average rates of return were up in and around 8 to 12% annualized for all clients, depending on if you have growth, balanced, or max growth portfolio. But to be close to double digits, it's well above in a volatile market, well above cash, double.
Not counting the tax advantage.
Yeah, the tax advantage is huge. So we're quite happy with the results. And if you were one of those pessimistic bears that was sitting on the sidelines and you were in cash, or you bought into that commodity story, sorry, last year was a tough year for you.
No question. And if you overweighted Canada dramatically, like a lot of people have a bias and a lot of people just specialize in Canada, you missed out on some phenomenal progress.
So Ken will go through, if you want to touch on more of the individual mandates, Ken will be walking through on the call. So
answer
feel
your
free.
phones.
So these next couple slides, more just information if you'd like to see, but I show the Toronto Stock Exchange. We have the leading contributors for the year, the leading detractors, the attribution detail in terms of the sectors, and you can see the moral of the story is it was mainly technology in Canada as a whole. Nothing else really went anywhere besides tech, 65% of the attribution. And then again, just to verify the numbers, you can see the leading contributors. Shopify up an astounding 118% for the year for a total contribution of 4.2. Crazy. S&P 500, kind of the same story here as you take a look at attribution details. Sector-wise, technology, again, leading. But you look at the top 10 names, it's basically the Mag 7 plus a couple others.
Yeah.
And look at the contribution on that side right there. Okay? S&P 500 does 24%.
Mm-hmm.
Those top names, if you actually sum it all together, is 16.62.
Yeah.
10 names, S&P 500, so 10 names does 16.24 or 67% of the actual rate of return. And the other 490 positions only account for a mere 33% of the rate of return. So
hence why a lot of people are believing the market, the breadth will widen and there'll be more participants going in. And, when the tide comes in, all boats get lifted. So, that's a positive outlook for 24.
Yeah. And so what that just tells you is it was a really, really uneven bear market. And if you didn't pick your individual names correctly, especially in the S&P 500, then you substantially underperformed. You take a look at this chart, and it was midway through the year, but the 7 largest companies on the S&P 500 now make up 29% to the overall share.
Yeah.
Then the chart to the right shows you the Meta, Amazon, Apple, Microsoft, Google, and NVIDIA up 71%. But then if you take what is the actual S&P 500 in gray, up 19. But if you remove the Mag 7 from that, up a mere 6%.
Yeah.
So very, very uneven. If you didn't have exposure to growth and you were just a value-orientated investing in the United States, it was a tough year for you. Low single-digit rates of return. And even if you were in energy, maybe negative. So very, very uneven on that front.
Yeah.
The next thing that I know I've been harping on the last quarterly calls and the luncheon presentations we have done is I have been a very big promoter of bonds over cash, right? I've given you the historical details of saying when we're at peak interest rates, bonds will always outperform cash. And so history repeated itself.
Absolutely.
We're at peak interest rates. Cash did under 5% at this point in time, and the Canadian FTSE bond market was over 6.2.
Yeah.
So it's that same story over and over again where we still think that bonds over the next little bit here are still a great place to be. Could it be overdone with everybody anticipating the 6 rate cuts? Yeah, it could be, but I think the long-term trend as we see moving forward is interest rates are going to have to decline. The 10-year is not going to stay in and around 4 for an extended period of time. And so the benefactor of that is going to be the bond portfolio, and being up 6 this year, I'm expecting to have positive returns coming in from that area. And even if we got no movement in terms of the actual duration component,
yields are great.
Our yields are northwards of 3.5 in and around 4% at this point in time. So you're being paid to wait, which is not necessarily a bad thing. And as we've educated all of you, the bond component is if some of those risks that Ken outlined and that I'm going to outline do come to fruition and we do inevitably get a recession, because a recession is inevitable, it's going to happen at some point.
Yeah.
Is we have the ability to take that dry powder and roll it into spaces that have been beat up. And that is the key premise of asset allocation. And it's imperative that you have dry powder in times like that.
Absolutely, because nobody has any idea. Are we going to hit a soft landing? Perhaps in the U.S. Are we going to have a recession in Canada? I think it's going to be mild, but are we going to have 2 down quarters of economic growth in Canada? I think we are.
I think we might. We'll go through that. But nobody has that crystal ball, and all the forecasters that were making projections over 2021 and 2022. If you really leaned into your convictions during that period of time, think the bull market's going to continue in 2022? Oh, wrong. You went to cash, or you maintained your equity exposure? Tough year in 2022. You think 2023 was going to continue on that time frame? Oh, rallies. So it would have been very tough to make those bold calls to where we were cautious yet optimistic. And it's all about not necessarily making those bold calls, but knowing the spots that you want to have exposure to and trimming and adding as the market makes its way throughout the year.
Yeah, not betting the house all in one, spot. Like you take one of the best so-called prize analysts, Michael Wilson from JP Morgan. He got it so deadly wrong last year. He missed the target on the S&P by over 1,100 points, or almost 24%. And he is still continuing to be bearish.
Yeah, it's
maybe
tough
pill
to swallow. Right?
By the time you get gray hair, maybe
there's a few coming.
Maybe by the time you do, his call might inevitably be right. We'll just have to wait to see.
Yeah. Alrighty. So next slide, I just want to go over cash in the long term, just to show you. And you already talked about GIC, so I'm not going to talk too much about this slide. But cash in the long term is never king. It can be in the short term. Use it at your disposal for short-term opportunities. But if you're going to stick to cash in the long run, this chart will tell you exactly what that is going to do to your overall rate of return. So don't really want to walk too far into that because we have gone over that multiple times. So I just wanted to outline the three biggest risks and kind of expand on what Ken was saying. But one of the biggest risks that we see out there is the U.S., their consumer resilience in terms of spending being tested here. Okay. And so as people started to form their views last year that we would inevitably head into a recession because of the large interest rate hikes that have happened, they kind of based it on history and looking at that 1970s scenario of stagflation, where you have high interest rates, which now basically defer consumers from spending. You have unemployment ticking up, and you have what is low rate of economic growth, while there maintains persistent inflation. And that was the story that didn't really, and it was the consensus view on the street.
Yeah.
But it didn't play out mainly due to the fact that the U.S. consumer was resilient.
Incredible.
And I think the reason why the street got it wrong was for two reasons. One is everybody understands that monetary policy has long lag times, but I think the street forgot how long.
Yes.
Okay.
Absolutely.
Very long. Not saying that they're incorrect, but they definitely didn't understand the length at which it takes policy changes to articulate its way and make its way through the economy.
Kick in and do what it's supposed to do.
Exactly. The second point being is it's very difficult to forecast human behavior. And so there was a lot of animal spirits that happened in 2022 or 2023, actually dating back to what transpired during COVID. So people were locked in their homes for 2 years, had nothing to do. You couldn't go travel. You had to get your little app to come back into Canada. Remember that?
Oh, yeah.
Just the pain. You didn't go out to bars and all that. And so I think over the last year and a half, there were a lot of people that ended up kind of taking back time.
Oh, yeah.
And so how are you supposed to, with all of your market models, price in the elements of human behavior that people wanted to get out after being cooped up for so long and spend money? I want to go spend $10,000 on Taylor Swift concert tickets.
Yeah,
would never do it, but people were sure spending money because they were cooped up and people were traveling. And I think that is also what really a lot of Wall Street and Bay Street got wrong. The lag times, but also the factor of consumers just needing to get out there and enjoy their lives and spend and make up for lost time. But I think that story is going to be a little bit different as, I would say, the hangover starts to set in. So we are getting into now, I'd say, the longer phase of that spending. They've been spending heavily, propping up the economy. But as you can see from the chart here, a lot of it has started to come from the excess savings that were built up during COVID. And it's being depleted very fast. And so if U.S. GDP is made up of 70% of the consumer, and we have, yes, it maintained resistance last year, but if it is slowly degrading, that is a big concern because that is going to inevitably eat into corporate profits. So something we're watching very closely, but if it does turn, it's obviously a very big cause for concern.
Mm-hmm.
Next area of concern is just the Canadian economy and a Bank of Canada policy mistake. Ken and I have been talking at length about Canada being
a terrible place to invest, to call it straight out. We love Canada. We're proud to be Canadians, but wow, do we have a lot of challenges in this country.
Tough place to be, starting with just the real estate. I don't want to hamper onto it. We have so many mortgages coming due in 2026 that were the 2021 people that got into the home market, locked in at an interest rate of 1.8%, and now we're going to have to refinance at levels northwards of 5%.
Yeah.
I got news for you. That is going to obliterate your discretionary income.
Oh,
and that's going to be tough on a lot of the millennials, a lot of other families that are just scraping by.
A lot more part-time Uber drivers coming up real soon.
The other thing being is I think the Bank of Canada, they're too concerned with the inflation figure. I'm not going to touch on the U.S. That's a different story, but I think there's room for a policy error here. They're holding these rates just looking at inflation, saying that it's still not near our target. It's still not near our target. And we are prepared, if necessary, to raise interest rates to hamper that, to bring it down to target. But if we take a look at what's happening, if we actually take a look at CPI X shelter, okay? CPI X shelter is actually back in line with the Bank of Canada's target. Already. You've done it, but being the lagging effect that monetary policy is, we're still at these levels. So there's more room to slide on that front.
Absolutely.
But then if we take a look at the CPI holistically and take back into account shelter, it tells a different story. Mm-hmm. But shelter within itself, we've talked at length about this, that the rental component of CPI is flawed. But we also have on top of that, the survey, we don't need to get into that. But on top of that, we take into account that Canada has let in terms of immigration,
1 million.
A staggering amount.
Yeah, I think it's like a 1.2 million this year.
And so it's 1.2 million is on the slide right there. So look at you. You just know the numbers off the top of your head. But it's amazing to see as we let in, obviously, the immigration policy becomes more lax, is the CPI shelter component continues to follow with it. We're letting in more people into this country, which is great, but where do we put them in terms of housing? The only thing that's going to follow, as we've seen, is the shelter component is going to continue to increase. So if we maintain an immigration policy that is excessive, then we should just expect CPI from the shelter component to continue on while the rest declines. But if we were to stop, we're already near target. So the policy mistake is if we do not cut sooner than later and immigration starts to halt, I think we're in for a rude awakening from the standpoint of substantial real estate correction, number one, weak economic growth as a whole, to which the Bank of Canada, in our opinion, is going to have to cut rates so much drastically faster than the United States as a whole. So that's why, from a fixed income standpoint, Canadian equity or Canadian bonds instead of U.S. bonds is what we prefer to hold due to that premise.
Yeah.
The last one that I'm not going to touch on too much, went forward, not backwards, is the geopolitics. The list can go on and on here, but there are so many different things at play, from Russia, Ukraine, Israel, Hamas. The revival of supply chain issues is actually starting to kind of have an effect with what transpired between the U.S. in the Red Sea with the Iran-backed, forget the rebel group there, but a lot of freighters now are diverting their shipping instead of going through the Suez Canal and taking the shortcut, are now diverting around Cape Cod, which has caused
a huge spike
in the price of shipping.
Yeah.
Right? We had that huge spike during COVID because it's COVID, supply chain is a nightmare, but now we're starting to see it tick up because it's more expensive to take the long route around South Africa than cut straight through. And that's all because of geopolitical conflicts. We also have the November election coming up, and we also have challenges.
And if you watched the Iowa debate last night, Santos, give me a break. Haley, I thought you were better, but Trump's nowhere to be found. I might want to put that one up here because Trump gets back in, and we don't want to get into politics here, but it could be very disruptive for the globe.
Definitely. So those are just some challenges. In just being conscious of time, we should just move forward here a little bit. Yeah, I think the only positive here, Ken already touched on it, $5.9 trillion of cash in the money market. I think that if some of these issues do come to fruition, that cash that has underperformed so dramatically is quickly going to find its way back into the bond market. And any type of volatility to the downside, I think is going to be quickly eaten up.
Yep.
So long story short, just summing it up here, the mandate strategy is this. A couple things here. We're going to rebalance and take profits. The areas that did well, we're trimming back to the original weight, U.S. focused growth, international growth, not reducing them in nature, but we are taking profits and bringing them back down to our long-term strategic weight. Okay. The second thing that we're doing is we're looking to close global infrastructure due to the premise that we don't really have much confidence in Europe at this juncture. We don't have much confidence
farther than Germany
in some of those names so much anymore, and it's such a small portion of our portfolio that we would rather have it in the Canadian equity space, which already has exposure to those areas, and really benefit from the dividend tax credit as a whole. And it's because it's that small component. If we ever needed to open up a pure infrastructure component, then again, we are interviewing alternative infrastructure managers that I think would add definitely a benefit from a non-correlated component in that alt strategy if need be. But I think with all that's going on internationally, we want to have a little bit more of home bias this year and really be cautious of where we step in the equity realm. So closing that, what we're also planning on doing is we're increasing our cash position to 5%. This is not a long-term cash hold. This is a short-term cash hold due to us taking profits and looking for places to place it. It's a strategic
move.
It's a tactical deviation. So we are looking to raise that cash, and if things do unwind, we want to have dry powder to buy things at a discount. And that is what we plan on raising. We're going to be still yielding 5% in money market, but it's not like we're going to be sitting there for very long. Until an opportunity presents itself, we just want to have some dry powder to be able to buy. On top of the fixed income component that we already have.
Absolutely. I think it's a great call.
And then maintaining our vault exposure is number 4, making sure that uncorrelated component remains. And then also slightly bumping up the fixed income as a whole, because we still have the premise that yields are going to fall from here. So the changes are here, cash up, fixed income up. We're going to rebalance high income, even though we're pessimistic on the Canadian space. I think just to rebalance back to the original weight is a no-brainer with banks still yielding 6% at this juncture.
At some point in time, you can't give up on Canadian banks.
No.
At some point, they're going to join the party.
So slightly uptick, nothing too aggressive, just getting it back to its original weight, trimming U.S.-focused growth. Nothing is really happening with small cap. We're going to leave it as is. I think there may be a little bit of an overbought segment right now from what happened in November. Decreasing international growth, maintaining our weight in strategic alternatives, and then closing global infrastructure. Okay? So long-winded story is there's not too many drastic changes. We're taking a little bit of caution since we did so well last year. Basically double-digit rates of return for most of our clients. High single digits is a very, very good year. Take some profits. Be cautious of what lays ahead, because if risks do unfold, we want to have the ability to capitalize. And that is what
Just
our
like we did-
strategy is for heading into 2024. Nothing overdone, but being cautiously optimistic and choosing our spots wisely.
Similar to 2021.
Exactly.
And when I'm calling all of you to give you your review, which I'm sure you're going to get into, I'll be able to go over all of that with you one more time.
Exactly. So Ken will be giving the reviews starting next week when the performance reports come to you. Hopefully you've all had the time to actually watch this video.
Please watch it. Thank you.
And the new performance report will be sent to you. Have a look at it. If you have questions, Ken will walk you through it. I'll also be giving some calls as well. And that's pretty much it. So
cheers to a successful new year. And, thank you for taking the time to listen. I'd like to thank Cody for all his amazing work. Certainly when you get your new performance report, the old guy didn't do anything in that regard. It's all from the brainchild here, but it's really one of the best reporting performance reports I've seen in the industry. So when I'm making these 95 calls, it does take a while. It would really help, and I'd appreciate it if you could formulate any questions, watch this video a couple times, and certainly I look forward to talking to all of you very soon.
Great. Okay, well, thank you all for watching this video, and we'll touch base soon.
Thanks
Bye-bye.
very much.